Active investing is quite a simple notion in itself, really. If you're investing money, you're doing so because you want that asset to grow, you want to protect it against inflation, you want to use it to help you live the life you want to live. When you're investing it, you have a huge range of different things you can do. There's, thousands and thousands of things you could do with that money. You're buying something with a view to profiting or joining in on its growth, getting your share of its profit. Typically that's a share in a business, it's debt, could be property, it's all sorts of things it could be. And the idea of active investing is that you or somebody you entrust, a fund manager or an advisor, is making conscious decisions to buy or sell or buy and sell that asset at specific times in specific ways that's going to generate some kind of outperformance. They're also making decisions about exactly what to buy and that buying X is going to do better than selling Y and so on. So making those active decisions should outperform generally the market, and that's the notion of active investing. You're making conscious choices to buy things, sell things to generate that outperformance. In short, because nobody has a crystal ball, you can have the strongest, most educated, most well-paid research teams with access to all the data in the world, who can paint and tell really good stories about what's going to happen next and why it's going to happen next and why certain opportunities exist. But the key thing is, and the last few years have really rammed this home for us, that there's always something around the corner that is not expected. Look over the last few years, we've had the COVID situation, we've had the Ukraine war, we've had inflationary crises, and that's just in the last few years. You can't predict these things, so as good a story as it might be last week, next week it's not going to be. And we don't know what's going to happen. So getting it right in advance is not impossible to do consistently. So the notion of market timing is a really difficult one. It relies on people trying to essentially guess when the market's going to go up or when it's going to go down, and to take profits or to get opportunities they wouldn't otherwise have had because of the time of that purchase. So for example, if in COVID, if someone could have understood that markets were going to tear away after they had fallen down significantly, they would invest heavily at that point and benefit in full from that rise. But of course, it's almost impossible to get right. And the other key market timing is getting it right when it's about to fall as well. So markets have been rising and rising, take your money out, bank any kind of profits, put it in cash at that time when they've been consistently rising. And the difficulty there is again just getting it right, because no one has a crystal ball, no one knows, and we've seen this time and again in recent years. So the notion of market timing, getting it right, relies on doing it twice, getting it right on the way out and then on the way back in. And because nobody has a crystal ball, because nobody can foresee future events, getting it right twice on a consistent basis is almost impossible. Active fund managers have the same challenges that anybody else has trying to invest in an active fashion. So they have to select stocks or indeed bonds that are going to outperform. They have to engage in market timing, and they can have hugely well-resourced research teams. They can be very well-connected people. They can be hugely well-educated and work extremely hard. And they can paint really, really engaging pictures. And the difficulty they have, though, crucially, is that they just can't predict the future, the same as everybody else. These strong research teams, all of this extra work, all comes at a cost. So active managers are incurring an additional cost to do all of this work for you, essentially taking bets that certain funds are going to outperform markets, that certain aspects of timing are going to offer that additional outperformance. But getting it right, again, consistently is extremely difficult. Some do get it right, but what we tend to see is that, for example, if you look at fund groupings on any given year, perhaps the last couple of years, the funds in the top quartile won't be there when you look in the next couple of years. And because of the costs involved, they've got quite a level of outperformance that they have to add in addition to the market as a whole in terms of adding value. So yeah, some do, but the ones that do don't do it consistently. So how on earth do you select in advance which funds are going to do it in the future, and then select that again as to who's going to do it again? Almost impossible. It's the proverbial needle in a haystack, really.